Okay, so hello everyone. This is our first time homebuyer webinar. We're excited to have you here joining us. Go ahead and Stacey.
Hello, I'm Stacey Sandoe with Coldwell Banker Kappel Gateway Realty, and I'm here with Elaine Sciacca from Coldwell Banker and Stephanie Ham, who is our special guest from Caliber Home Loans.
Excellent. So during this webinar, we're going to go ahead and say that it's probably going to be about 30 minutes. And we're going to cover financing, search criteria, home search process, going under contract, that transaction process, and closing. We're predominantly going to focus on things that you need to know for your purchase, and then just kind of go over each of the steps along the way briefly. We're going to begin that by starting with financing with Stephanie. She's going to cover these topics. Go ahead, Steph.
Okay, let me get my screen up here. So hopefully you can all see my first slide. We're going to be talking about the 7 topics that I receive the most questions about. So choosing a lender, application, pre-approval, types of loans, credit, closing costs, and down payment. So choosing a lender, the first thing you can do is ask your family and friends who've recently got a mortgage, who did you use and were you happy? Also, you can consult with the realtor that you're working with because they are subject matter experts in this area and they work with a lot of lenders. Some they would recommend and some they would certainly not recommend. And once you have a couple of names that you feel comfortable with, you're going to use your friend Google and you're going to plug those names in. You want to find someone that Google knows, right? So you want some social proof. If you've got a lender that does not come up in the search or doesn't come up with favorable reviews, maybe, you know, that's an issue that you should consider. This is going to be your largest investment and you want to make sure that it's handled by a professional. So those would be my recommendations on how to find your lender. And what that lender is going to want to do is they're going to want to take a mortgage application from you. And what a loan application is basically a universally accepted credit application. It's a 4-page document and it collects all of the basic information about you. What is your name? When were you born? Where do you physically live? What do you earn? What do you spend? You know, so it's just a series of questions that all goes into a form that every underwriter in America uses to determine loan approval. So the application includes a credit check as well, because the credit information as far as what you owe and what your scores are part of that process. So it's just an overall picture of your financial scenario. And what we're going to be doing once we have the loan application is seeking to get you a pre-approval. So you might hear people say pre-qualification, pre-approval. The difference between a pre-qualification and a pre-approval is that somebody should have reviewed some documents to get you pre-approved. And that means, so you entered in information in a loan application, a professional took a look at that, made sure that it looked right, requested the appropriate documents from you to verify that the information you gave us is documentable, right? So for some people, they might think they make one figure per month, but then when we get the paperwork back, it might be different, right? So it's important to get documentation and review that. And then once we are sure we have good data, we're going to typically automate a loan approval for you. So that means we take all the data that you've given us and we run it through an automated underwriting process for the loan type that you've chosen, and it will issue us an automated loan approval instantly. And that loan approval tells us that as long as we can document the data we fed in and it's accurate, then we're going to close that loan for you. So when you're pre-approved, it means that you've done everything you can do ahead of time to make sure that your loan is going to close and that you're comfortable with the payment that you're taking on when you make your purchase and the cash that you need in order to close the transaction. So all of that should be clear for you. Why is it important to be pre-approved? Well, the pre-approval does a number of things for you. Make sure that you're not shopping for a home that's outside of your affordable price range, for one thing. A lot of times we go to the internet today to figure something out initially, and if you're looking on websites for for homes, they're going to have estimated payment information. So you might think you're looking at one price point, and then when you talk to a lender, find out it's extremely different. And that might be because, number one, when you're looking online and they show you property tax information, that is based on what the seller is currently assessed at. And there's nothing to do with what you're going to be assessed at when you buy the property. So the taxes can be quite different. They're also assuming a lot of things online, like, for example, that you're putting 20% down. Not so much typically. So anyway, it's important to make sure that you're getting your information from a professional and not necessarily just from the internet. And then that professional should also go through what you need for down payment for your loan program and what you need for closing costs. So you should have a total picture of what this means for you financially. When you do your pre-approval homework up front, that means there should be no reason that you're going to be in jeopardy of losing your earnest money deposit, which Stacey will cover later. And if something goes wrong with your loan approval, not only do you lose some money probably, but you also lose your dream home, right? So that's pretty devastating. The other thing is, if you call a realtor to go see a property, they're probably going to ask you for a pre-approval letter. And that is really true more so with COVID days than any other, because the seller doesn't just want anyone walking through their home, right? They want to make sure that you're a serious buyer and your pre-approval letter says that you are. And then if you like the home and make an offer, your lender letter is your ticket to get that offer presented. Most times listing agents aren't going to present an offer without a lender letter at all. So there's different types of loans. And when we get your loan application, we're going to try to figure out which loan type suits your needs best. We have government loans, and that would be your FHA, VA, USDA. That literally means the government insures those loans. So if they go bad, they pay the lender whatever they lose on the borrower when they default. So they're government-backed loans. Then there's conventional loans, and that would be when you hear about Fannie Mae or Freddie Mac. These are government-sponsored enterprises, but not technically government-insured loans. And then you'll also have some jumbo, bond, and portfolio loans. So a jumbo loan would be a loan for an amount that is over the county loan limit. And every county has their own loan limit, and it's determined annually. So if you need more money than the loan limit, we go into a whole new product world called jumbo. And then bond loans would be a fancy way to describe down payment assistance. So here in California, most commonly we have Golden State Finance Authority loans and CalHAPA loans. So those loans are made possible by bonds, state bonds. And then portfolio products. So that would be products that your traditional borrower or your traditional lender is not, looking to make loans to that kind of a borrower for whatever reason. Maybe you had a recent foreclosure, short sale, bankruptcy. Maybe you're self-employed and you want to use bank statements to qualify instead of tax returns. So anything that does not fit into the typical lending box, we would try to use a portfolio product for that. Credit scores. The key to all home ownership is that we have usually got to have some developed credit. There's a lot of misinformation out there in the world about credit scores. One of the most common questions I get from clients is, why are there so many of them, right? So my credit card tells me my score is one thing, and my Credit Karma tells me my score is another, and you, loan officer, just told me my score is something different. So there's 55 different credit scoring models out there. Consumers have access to consumer versions, but only a lender has access to a mortgage version. So no matter if you come and see me or you go and see your banker, we're going to get the same credit scores when we make a mortgage inquiry on your credit. And your score is comprised of 5 different calculations. So the scores are analyzing your payment history. It's the best way to have good credit is to make all your payments on time. That's 35% of your score. Your scores are analyzing the amount of money that you owe on revolving debt. So a revolving debt would be something that changes, like a credit card. It doesn't consider installment debt, which would be something like an auto loan where you borrow a fixed amount and you repay a fixed amount every month. Revolving debt's just your credit cards, which can fluctuate. So the fastest way to increase your credit score is to take a look at your balance to limit ratio on the cards, meaning if I have a $1,000 limit and a $500 balance, I'm at 50%. So that particular score for that trade line is not going to be reflecting as high as it could as if you maybe had a 10 to 30% utilization ratio. So if you're looking for a quick boost on scores, we are going to analyze that and say, hey, if you pay the city card down to X, then we should see an increase. And sometimes that can help us get you a little bit better rate, or approved at all, right? Depending on the score that we're talking about. 10% of your score is comprised of new credit. So that means like when you go open a new card and get an inquiry on your credit. So inquiries are in that 10% category. Length of credit history. So all active trade lines that have been used in the last 6 months are considered in your credit history. And they're looking to do an average of how long each one of those have been open. So that's why people sometimes say don't close old accounts and don't open a lot of new accounts, because you're affecting that length of credit history, which is 15% of your total score. And then the final 10% of the analysis makes up the credit mix. So they're looking to see, do you have a history of managing different types of credit? So for example, a mortgage reports specifically, an installment debt that we mentioned, might be a car loan, could be an education loan, could be a loan from Discover Bank where they gave you 50 grand and you pay them 400 a month. Those are installment debts. They're looking to see that you have a combination of different types of debts and that you've managed those well. Okay, closing costs. There are 2 types of closing costs, recurring and non-recurring. So recurring closing costs are things that you cover what you would always normally pay for as a homeowner, which would be interest for your mortgage, insurance for your property, and taxes for your property. So if you are buying a home and establishing something called an impound account, which all government loans require and conventional loans require if you don't put more than if you put 10% or less down, less than 10%, I should say, down, then you have to have an impound account. And that's an account where we collect a certain number of taxes and insurance at closing to pre-fill the account for you so that there's enough money in the account to pay those bills as they become due throughout the year. So recurring closing costs, you can consider, they're not for one-time fees that you're paying. Some of that money isn't even being spent. It's simply going from your savings account to the lender's savings account that they maintain for you. And every month when you make a payment, your insurance and tax portion peels off and adds to that account. And then whenever there's a bill due for insurance and taxes, the money comes from that account. So recurring closing costs cover the establishment of that, also paying for 1 year of homeowner's insurance at closing, and then any interest from the day the loan funds till that current month is over so that we can establish when the first payment will begin. Non-recurring closing costs, they're your one-time fees, like an appraisal, title and escrow fees, things of that nature. So that's money that you're paying in connection for services rendered to get closed. Different types of loans carry different types of down payment requirements. So our FHA loan has a 3.5% minimum. VA is 0 down, and a big change occurred in 2020. We used to be able to allow a veteran to put nothing down up to the county loan limit. Now the veteran can put nothing down up to infinity, but we cap it at 2 million. So that's pretty huge. Conventional loans allow as little as 3% down. A USDA loan is 0 down. Now that's a rural program. So unless you're buying a property in a pretty rural area, you probably don't qualify for USDA. If you Google USDA census tract, you can actually put an address in and check if you're curious. Where does down payment come from? Down payment can come from your savings, a gift, a loan or withdrawal from your retirement account. It cannot come from your mattress, and it cannot come from your credit card. There are also down payment assistance programs through state and local government. Those are not a free lunch program. They're literally for people that don't have any other way to get down payment and closing costs. They're more expensive types of financing. Believe it or not, the rate is higher on those and the closing costs are higher. So you'll want to go through your options with your loan officer and take a look at that and see what makes sense for you. And that's it. That's what I've got. So I will go ahead and pass the screen back to you, ladies, until you need me again.
Thank you, Stephanie. That was excellent. There were a couple of in the chat box for you, Steph. So if you want to check in that and follow up on that, and Julio, she'll get to all your questions. They were really good. And anyone else watching right now can go ahead and check their chat box too. If you're curious about those same things, she'll go over those. I'm going to be talking about things that you might want to consider when you are looking for your home. So now that you have your pre-approval letter from your lender and you know how much you can afford, now you want to really start thinking about things that you want in your future home. So first thing is location, and that's something that you cannot change about your home ever, right? It's always going to be in the same spot. People don't usually pick them up and move them. So that's very important to consider. Also the price, that now you'll know exactly what price range you can be shopping in because you've spoken to your lender and seen what you can qualify for. Square feet, bedrooms, baths, those are pretty self-explanatory. So of course, you know, think about your current living situation and do you need something bigger or smaller or the same size, whatever's manageable for you. Style, a lot of times people have a preference on style, colonial, craftsman, different things like that. Oftentimes for first-time home buyers, they just want a home that is cute on the outside or, you know, feels warm inside. So you'll know that once you find it. And different features like open concept. Do you need RV parking because you have a business where you have to, you know, haul things, or different things like that, or different special features that you might want to tell your agent you're looking for. Swimming pool oftentimes is very desirable, especially in our climate. And then schools, there's a great resource, it's called greatschools.org, and you can research the schools in that area. This gives you, sometimes they have parent comments, sometimes they have a rating for the school that's in that area and neighborhood that you might want to be looking. The next item is going to be, how are you going to find these properties once you know what you're looking for? So you will have your agent as a resource, and they have access to MLS, which is multiple listing service. This is a program or database that's established by cooperating brokers in that area. So ours is called Berries, and we use that to look at for properties that are currently for sale, pending, or have sold. So, and then we also use our agent network. We have a large agent network here at Coldwell Banker. We have over 200 agents, and so we're going to go ahead and send an email out saying, hey, I have this buyer who's looking for X, Y, and Z on this house. They want a 4-bedroom, 2-bathroom, 2,000 square foot home for this price. Does anyone have anything coming up soon? Or they'll even talk to the agents who are part of our Realtors Association if they belong to that and see if they have something. Generally, real estate agents have their own website and app. Stacey and I both have that, and you can search right on those for your home. That's always updated with the current MLS data, straight from MLS to our websites and apps, so that you always have the most current information on homes for sale. As a customer, you probably have already, or as somebody who is in the market for a home, you've probably already been looking on websites, maybe Zillow, Trulia, any one of those, and those are secondary fed websites, so they all get their information from another website, which makes it so that they don't get it as quickly as some Coldwell Banker's websites do, but they're still very accurate. Generally, they update within a day or so. You can even drive through a neighborhood, look for yard signs. Open houses aren't possible right now due to the COVID, but virtual open houses are becoming a thing. So when you're searching for a home online, oftentimes they'll have a link for a virtual open house that you can click on and register for, just like you did this webinar, and they'll take you to see that home virtually, which is very cool. Model homes, if you're looking for a new build, even ask your friends. Maybe they know somebody who's going to be selling their home soon. And then of course there's always for sale by owner, and that's something that you can find out generally by driving through a neighborhood that you're interested in. And an agent can always help you with a for sale by owner situation as well. And then there's high-tech tools, which a lot of times you can sign up for a system where you put in your parameters of your search, and then it will directly send you when a home that fits inside your criteria comes on the market. Next, we'll talk about making an offer. So your agent's going to help you make your offer once you find this property that you have been looking for, your home of your dreams. You've found it, and now you want to make an offer on it. So your agent's going to assist you in making a good offer on that property. They will typically run a comparative market analysis, which is going to take into consideration all of the market, and this is going to contain the solds, the for sale, and the pending sale properties in that neighborhood, generally within a 1-mile radius. And it's going to say, hey, these homes have been selling for this much, and this is how much about how much this home should be worth. And they'll get a very good idea of that because we do this all the time. So we have an experience doing that type of thing, and making sure that you know you're making a good offer and at a fair price for what this home is worth. And then we'll also present and negotiate this offer. So, oh, sorry, I skipped prepare. But we're going to prepare this offer with you. We're going to go through the entire contract, and that includes more than just the price. That's not the only thing that's going to be negotiated. There are other items. There's timelines, contingencies for inspections, the appraisal, the loan to consider. And sometimes the seller will have a need or a desire for a longer or shorter escrow, and you can negotiate that. And making an offer with their desired parameters is oftentimes more attractive. So we're going to try and get you the most attractive offer. And there's other terms like what will convey and things like that to consider when you are writing your contract. The next we're going to do is present this offer to the listing agent of that property or whoever might be selling it. And we'll go ahead and negotiate that. Best case scenario would be that they accept your offer exactly as you wrote it, because this is all the things that you desire. However, most of the time there's a counter offer to that, or sometimes they are rejected. But we would love a counter, and we'll help you negotiate all of those terms down to hopefully an agreement. And that would be you going under contract when both of you have agreed on those terms, and now you are in contract. And Stacey's going to go ahead and talk about that transaction now that you are in contract.
Hello. So your offer's been accepted by all parties, so you're officially in contract or in escrow. And this is where the earnest money deposit comes in. The earnest money deposit is your good faith deposit. It lets the seller know how serious you are about buying their home. The good faith deposit is deposited into escrow within 3 business days of the acceptance of the offer. Your this earnest money deposit will be, you should expect that it's going to be anywhere from 1% to 3% of the purchase price. And the reason this is in there, not only to just show the seller that you're serious about the house and that you want to move forward and will move forward, it also, in the unlikely event that you default on the contract, the deposit is the seller's recourse for that default. However, it's your agent's job to keep you from defaulting and protecting your deposit. Your deposit, even though it's held in escrow, will go towards your down payment and closing costs. So it would just come in that much less than before. So what is title and escrow? So title and escrow companies are the neutral third parties between the sellers and the buyers. Escrow officers make sure that all the funds are received and distributed to where they need to go. They also calculate the property taxes, as property taxes are only paid twice a year. So they make sure the right amount is paid by the right appropriate party, and that the other party receives their refund, because it will change every time. And I leave property taxes to escrow officer. They can handle that mess. Title officers make sure that the property is free and clear at closing. They research the property's title change to make sure that there's no hidden liens or deeds of trust on the title change. Title insurance is one of your non-recurring closing costs, and that ensures that the title is free and clear when you become the owner of the property. It also ensures that if something were to show up years later on the title from a previous owner, like maybe a mechanic's lien or something like that, the title company would be responsible for taking care of it and clearing the title because they missed it. It doesn't happen very often, but you know, there's always that one time. So next we'll go to communication. So communication, as your realtor, it's our job to manage the transaction by communicating with you, the buyer, the listing agent, your lender, the escrow officer, and any inspectors that are hired during the transaction. Clear and concise communication is key to a smooth transaction. And for an agent, knowing how to anticipate problems or issues before they become a deal breaker is also key to the job that we do in protecting you. Not everything can be anticipated, but we do our best to try to make the home buying experience as stress-free as possible. So in the contract, there's timelines that have to be monitored. And that's part of the management that we do, I mean. So there's the first timeline would be how many days is the escrow. So an escrow can be anywhere from 30 to 45 days. Sometimes, if there's a cash buyer, or, well, if you're a first-time buyer and you're a cash buyer, then you are the one we want to have. But typically 30 days is about average right now, depending on the loan. But we can have shorter times. We can also have longer times. It just kind of depends on the situation. Within that escrow timeline, that 30 days, there's additional timelines that go with it. And these are your contingencies. And we have contingencies for the appraisal, for the loan, for the inspections. Each one has its own timeline. Appraisal and inspections are typically 17 days, and the loan approval is typically 21. I say typically because each contract's different. There can potentially be other contingencies that are not your contingencies, but maybe on the seller side, like contingency for them to find a replacement property, or for them to close escrow on a replacement property. No two escrows are the same. Each and every one is different because there's different buyers, different sellers, different houses, different lenders, different mortgages, different. So each one we will go forward with yours based on your contract. So as Stephanie mentioned, the appraisal is something that the lender will order immediately after receiving the ratified contract. An appraisal is ordered to determine what the property's value is at the time of purchase. This is where determining how much to offer for the property when you're writing the offer is very important, because the lender will not lend more money than the property is worth. So if you make too high of an offer and expect that, oh, when the appraisal comes in, we'll chop it down, that doesn't work. The sellers and listing agents know how to handle that. So it's much better to write a real viable offer than to overinflate it. So the appraiser is a neutral third party, just like title and escrow. They technically work for you, the buyer, but they work independently so that they're not influenced by either side. The appraisal is based on real-time data, based on what is sold in a mile radius and in the last 90 days. And they look for the comparable properties that are closest model match to the property that you want to buy. So within 17 days of acceptance of your offer, we will also investigate the property. This includes not only the physical inspections, such as the roof, pest, chimney, pool, if there is one, and HVAC, which is the heating and air conditioning system, and the whole house. There can be also additional inspections needed if you're buying a country property, such as the well or the septic system. In addition to physical inspections, we will also have the seller's disclosures about what they know about the house to review. We'll have the preliminary title report from Title and Escrow, and the natural hazard report, which is required by the state of California, as well as any inspections the seller may have that they completed prior to putting the house up for sale. Now we are back to loan approval. And Stephanie, can you please tell me what's involved with getting the loan approved?
Absolutely. So what we will go ahead and do when the contract comes in is we will tailor your math to match that contract, and we'll send out your disclosures. You'll sign them. We should already have all your documents, so we're going to submit that to underwriting. The underwriter is going to approve the loan conditionally, and that means we have to satisfy some things before we can close, but they're going to review all the income and assets and everything we provide to make sure it's good to go. So the conditional approval, you can expect to see one of the conditions be an appraisal, for example, a acceptable preliminary title report. Maybe we need to update a pay stub. So those would be typical conditions on your loan approval. And you're going to have 3 types of conditions: prior to closing disclosure, prior to doc, and prior to funding. So a closing disclosure is something that it finalizes all the numbers for a buyer. Maybe there's been a change since you got into contract. Maybe you did some inspections and you negotiated for some seller credit, for example. So we're going to finalize all of the math in its final form in a closing disclosure, once we have enough of the conditions on your loan approval met, we need the appraisal in and the prelim, and then typically we've got enough to get clear for that closing disclosure. Once we send that out and you sign it, we can let you sign loan documents 3 days later. So we'll try to get that closing disclosure out first thing, so that maybe we're wrapping up a few conditions to be signed off in underwriting. And so by the time your 3-day wait period's up, we should have those conditions cleared so we can go ahead and put docs and title. And then once we get docs and title, the only conditions remaining on your loan approval will be something called funding conditions. Funding conditions are just to put the bow on everything. So for example, if you're supposed to bring in $10,000 from your Bank of America account, one of the funding conditions will be to verify the cash to close came from that account. So if your cash to close comes from Chase, we have a problem, right? So that's your loan approval. You're going to have it approved, subject to meeting all your conditions. One condition, of course, is to maintain your job, things of that nature. The income can't change. You should not be getting new debts. You can't change all of those things. So as long as you can meet all your final conditions, your loan approval is going to be knocked out. You'll be no problems.
All right, thank you, Stephanie. So now we're on to the actual closing and that. So in California, we do not give keys when you sign the paperwork. There are plenty of states out there that you sign your paperwork and they hand you the keys before you leave. California, no, we don't do that. So once your loan docs are received into escrow, we can schedule a signing of the docs. This is completed either at the title company or at your current residence or place of business with a mobile notary. Either way, you'll need to have your driver's license with you for the notary who will verify your identity. The notary will also have you fingerprinted as well. Once your signing is complete, you will then need to transfer your down payment and closing costs to the title company. We recommend going to the bank and having a wire transfer completed, but you can also use a cashier's check. You cannot use a personal check. So wire or cashier's check are your two options. If you're gonna wire, we do recommend you go to your bank because we want them to verify where the wire is going. And anytime you wire money, whether be your deposit at the beginning or your down payment at the end, you always want to verify the wiring instructions because wire fraud is a very real risk, especially when you're wiring a large sum of money. So that we always will call the title company and verify that account number. Once you sign your loan docs, the docs are sent back to escrow for your lender to review. Once they review the docs, the lender will check your credit again. And given our current COVID environment, they may also check your employment again as well. It's very important that during escrow not to make any large purchases, such as new appliances for your new home or buying a car or co-signing for anybody else. Things like that. You want to keep everything the same, like Stephanie was saying, so we don't have any problems at the end. So once your funds have been received by escrow, the lender will fund the loan, usually the same day or the next day, depending on the lender. And once your escrow officer receives all the funds to transfer title, he or she will release the file to go to the recorder's office for recording. Once it records, then your realtor can give you the keys and congratulations, you just bought your first home. Yay! No, we need some confetti or something.
I know. Throw it up in the air.
We are here. We would love to assist you in purchasing your first home. There's a lot that goes into it. It can be very daunting, but with us as a team by your side, we can help you navigate through it.
Absolutely.
So myself, thank you so much for attending our virtual home buying seminar, and I hope you got a lot out of it.
Absolutely. And I've just put Stephanie's contact information up here for you. If you have further questions, I know we went over that very quickly. And if you needed to go deeper into one topic or another, or maybe just something was unclear and you need clarification, this is her contact information. You can even start an application if you're ready to do that at www.stephanieham.com. And then I'm going to also put up Stacey and my right, information, so that if you have questions for us just about home buying, maybe you're already ready to start your search and you have a pre-approval already and you just weren't sure exactly how to contact somebody to do that search, we're here and available. And I'm also going to go ahead and open up that chat. So I'm going to stop this real quickly and we're going to open the chat for any questions from you right now. We've been recording this, so we're going to stop the record, and then if you have questions, we'll discuss that with you right now if you'd like. So thank you for joining us. We really appreciated you stopping in and watching our webinar on first-time home buying.
Have a great night.
All right. Thank you.